All right, that concludes our moment of silence and our tribute to great 90s rapper Coolio. Passed away, 59 years young. They always go too soon, man.
Yeah, RIP. He's probably the first rapper I was even aware of and wasn't allowed to listen to, though retrospectively, very tame by modern standards.
Yeah, I was definitely, I can remember being in probably like second or third grade at skating rink. And when Gangsta's Paradise came on, I mean, the kids went crazy.
I mean, also big shout out Weird Al, Amish Paradise, also one of
arguably more famous.
Arguably, it's one of his best songs in my opinion.
So yeah, Coolio died yesterday. The market's reacting pretty adversely. Futures down a little bit, but we got a great rally yesterday, and the market's not responding to Coolio. We're done talking about it. Good day yesterday. I think everybody was glad to see a little bit of relief. What do you think ultimately, Tom? We've got kind of this wild matrix of things going on. I mean, we're sitting here. I was a little surprised at the strength the market picked up really pretty quickly in the morning. And what do you think kind of led to that?
I think it was the Bank of England announcement they were buying bonds. I think what happened there was we had just seen such widespread selling across the board in England, and England obviously sort of considers themselves the gem of the well, not so much European Union, but European adjacent countries. But there was a lot of just sympathetic selling across the bond world as a result of England's missteps with their tax cuts and their, central banking policy. And so I think there was just a little bit of they're doing something to try and stem the tide here. And I think there's just a little bit of a relief rally across bonds in Europe. There's definitely a big rally on the 10-year treasury yesterday afternoon. I think we got all the way down to about a 375, all the way down from 4%, which is a massive one-day move in terms of the 10-year treasury. So I think it was just a little bit of a sigh of relief. I'm not certain that it holds so much, but I mean, pretty much every stock was up except for Apple. Apple obviously was hurt by their announcement they were cutting production on the iPhone yesterday. But otherwise, I mean, it was green all around.
Yeah, I mean, it was an interesting day, and we're retracing some of that this morning, though futures were down more earlier today. Right now, Dow futures down 75 basis points ish. They're about flat. If you recall yesterday when we first started kind of looking through notes and stuff, at least when I did, Tom wrote the notes. I didn't do any of them. But when I first started looking at markets, we were down like 1.25 on the Dow, and the S&P was down a little more than that. So we have seen some positivity, and part of that may even be like we've got initial jobless claims rolling in right now. Tom, we came in at 193,000 in the latest week, so a fall of 16,000. I mean, there's just some of this data I'm just still having a hard time with.
Yeah, I don't know. I mean, it's not good news. I mean, this is definitely a good news is bad news situation in the sense that the initial jobless claims, again, coming in very low compared to estimates. And not only that, we saw the revision last month of even fewer initial jobless claims. And the more times we see this, the more emboldened the Fed is going to be. We're already seeing quite a bit of red on the bond side today. 10-year treasury up to a 381. So a little bit of a sell-off there from yesterday's rally. I mean, it's not great. It's definitely not what we were looking for. And on top of that, we also got the second revision here on GDP for Q2. And for the most part, everything was in line. The revised GDP. So the initial estimate was, down 0.6%. That came in down 0.6%. But the bad news is the GDP price index, which is essentially their version of inflation, came in hot. It came in at 9%. The initial reading when they did it the last time was 8.9%. And then core PCE, which is sort of the Fed's favorite view of inflation.
Yeah, they like it because it's a smaller number.
Yeah, it's a smaller number typically. But the core PCE, which was 4.4%, is now 4.7%. So not only was GDP down, so contracting economy, but they were also underestimating the level of inflation by their standards for Q2. And so that also is bad news. So we're having two things that are going against us in terms of the Fed interest rate hikes, which is one, the jobless claims came in under, and CPI, or their core PCE, and their personal consumption GDP price index came in high as well. So
yeah, and if you have on your morning Zoom bingo card, your free space right there in the middle of everybody is the Fed underestimating a component of inflation.
Yeah.
So go ahead and fill that one in.
Yeah.
I mean, it just keeps happening, and I don't know why we're surprised by it, but it just probably puts additional pressure on the Fed, and I don't know that it changes the narrative any. We talked about this at length, kind of in our investment committee meeting on Tuesday. I think you and I, Tom, are on the same page where we're expecting 2 more triple hikes between now and the end of the year.
Yeah, that's kind of where I've been sitting. I mean, if you look at futures now, we got a 70% chance of a triple hike in November. And then you're looking at, basically 2-ish, 2 plus. So a little over 2 in December. So, my expectation is they'll probably come in at 9. At no point in this whole process have they undershot it. And so I think that, that's the logical progression heading into the end of the year. And then if you look into the next potential meeting, which would be in February 1st, 2023, there is a slight chance that we would get an additional hike there based on futures.
Yeah, and it's not a problem. Obviously, if you've been listening to the calls this week, it's certainly not a problem that's isolated here. We continue to have concerns about Europe. Germany has seen their inflation rate, their CPI, rise to 10.9%. The expectation was for around 10.2. For context, the last reading was 8.8. Tom, likely to wreak havoc on rates.
Yeah, it's not good. I mean, it's they're basically the economic engine of the European Union and the Eurozone, and what the ECB is looking at, and they're coming in significantly hotter. I mean, they break it down by region, and it looks like, there's some areas like Bavaria year over year 10.8, North Rhineland 10.1, some of the lower areas, even are exceptionally high. Baden-Württemberg, I don't even know what region that would technically be, at 9.5. So all this stuff coming in, but they quoted what's called harmonized. It's EU harmonized German CPI. So that's all of the things together, plus kind of, I guess, a mix in with what European Union is together. And that came in at 10.9, which is just a massive year over year change. And even month over month, that's a big step up.
Simultaneously, Germany is redeploying COVID funds to combat gas prices. They're going to put out 150 billion euro borrowing limit to cap the cost of soaring natural gas prices. It's kind of being retermed a economic stabilization fund outside of the federal budget. So just kind of this pocket to, I guess, address just ongoing concerns on the energy side. And they're just going to keep.
Yeah. So the Christian Lindner, who's the finance minister for Germany, is kind of painted into a box. They need to do something in order to curb gas prices, but he also has positioned himself as this fiscal hawk, essentially saying there's going to be no new borrowing. We're not going to continue to just borrow to the moon and run up all this debt in order to stabilize the economy. So what he's done is basically found a way to circumvent that problem, which he's taken an old fund that was closed. There's $150 billion for COVID relief, and they're now repurposing that to spend on capping gas prices in order to keep it down. And so that way he can kind of play both sides, which is, one, he's using government funds to, stabilize prices. But on the other hand, he's also not necessarily adding net new borrowing to the balance sheet. And so, they're just in a pickle. Obviously, that we saw last night that NATO officially recognized the problems with the Nord Stream pipeline that's bubbling up in the Baltic Sea as sabotage. I don't think there's any read through on who potentially may have done that, but someone poked some holes in the Nord Stream pipeline. That's definitely not going to help Germany as at present, especially with their current CPI situation. CPI.
Yeah. And one of the things that's been interesting on the inflation piece is, we've been dealing with this pretty aggressively for 2 years. And I think one of the things that's interesting is just kind of these waves that we had. It felt like in late 2020, early 2021, it was really a lot of talk about the supply chain. But as it related to products, it felt like we talked a lot about materials like lumber. Lumber just ran like crazy, into the first quarter of 2021. Then we talked a lot about wage inflation. It was so hard to get people back to work. People were really trying to tackle the employment picture, trying to figure out how to compensate employees to an extent that was strong enough to get them to actually show up. Now we're seeing aluminum really just soar, up 8.5% on the London Metal Exchange, driven primarily by kind of these ongoing talks that there may be some Russian metal bans. Nickel's up, copper is up. just kind of this other pocket, another shoe falling on the inflation picture that's going to make it harder and harder. It's going to be a longer waiting game. There's going to be more pockets that pop up. It's not just energy like we've been talking about for the last, certainly in Q2 and later Q1 of this year. It's just so broad.
Yeah, I mean, it's just another way that the war in Ukraine is causing issues is that they're now look at other exports that are potentially benefiting Russia, and it's a big natural resource country. They've got mines all up in the Siberian range for gold, copper, nickel, aluminum, and basically the idea is that if we can cut off one more way of them making money, it's going to put even more pressure on them, and unfortunately, that puts pressure on everyone in the form of inflation. So. Not the best kind of Russian metal band, if you ask me. I went through a phase. I went through a Swedish power metal band phase, which is a weird time in my life.
Hey, nobody's perfect.
Yeah, Hammerfall. If you guys are looking for a really weird Swedish power metal band, Hammerfall is your go-to.
There we go. I'm sure we have a lot of people listening that are kind of looking for that.
Yeah, they never know.
They want to chase Coolio music with.
Yeah, they sing a lot about like the bros, but instead of bros, it's more like knights. Like we're all knights together. We're fighting. Nice. It's pretty sick stuff. a lot of solos.
In a bit of a surprise, Bed Bath & Beyond has found a way for their stock to go up. All they had to do was have the lowest second quarter revenue they've had in 16 years. They just needed a 28% year-over-year drop in sales and to announce a bunch of closures and layoffs. Stock's up, close to 3% on that news. So bad news is good news if you're Bed Bath & Beyond.
Yeah, I was reading through that this morning, and it's like they're basically saying, "Oh man, even though we've taken a 16-year step back in revenue, we're seeing a lot of traction on closing stores. They're trying to bring in more major brands, which is sort of their strategy at the outset, was to have all the best stuff inside of a Bed Bath & Beyond. But I think they kind of got away from that over the last 10 years or so. So they were all very positive. All the read-throughs were positive. They're trying to turn the ship around. So the stock's up 3%, but it is, I think, like $6 a share, and it was, in the high double digits to start the year. And so I don't have much hope for Bed Bath & Beyond, but it is worth noting we have talked about their death spiral quite a bit on this call, but it doesn't seem like they're having the best time, but it does look like it's improving.
Yeah, even with this little uptick, actually up 4% now pre-market. Even with that, they're down 62% over the last year. So, not something we're rushing to jump in on positive momentum by any means. We do get earnings from both Nike and Micron today, a little bit off cycle on some of these reports. Nike, I think, interested to see how they perform. I feel like analysts are really braced for the worst. So anything better than that could actually lead to. They're certainly not in the position that Bed Bath & Beyond are, so don't compare that. But bad news, but not awful news, could be good news for stock reaction.
Yeah, I think a lot of the read-through is going to be lockdowns. How much they're affected by China in terms of buying production. Though they do a lot of the production in Vietnam, but all that whole region has had quite a bit of lockdown action over the last year versus over here. Just a read through on the overall consumer, I think, as well.
And then we've got Micron, the whole chip space kind of in a tough portion of the cycle, which, honestly, the chip and semiconductor space in general, I think it's important to note, is cyclical. This is not necessarily solely based on some of these economic factors that we're facing. Certainly the supply chain thing can be a challenge, but this just tends to happen where chips are overproduced and there's excess inventory. This happens kind of on an ongoing cycle. We've seen this before. So they're kind of on the wrong side of that right now. Will be interesting to see how they're navigating everything. We will wrap it up. We're going to be here tomorrow morning, and we'll talk to you guys then.